Why did the Thai baht currency collapse in 1997? Imagine watching a country's economy suddenly lose its footing overnight. That's what happened to Thailand in 1997. The Thai baht, the country's money, plummeted in value. But what caused this sudden crash? Let's break it down. During the early 1990s, Thailand was growing very fast. People called it the Asian economic miracle because the economy was expanding between 8 and 12% each year. But this rapid growth came with some hidden problems. The country was borrowing a lot of money from abroad, especially short-term loans. It also had a big real estate bubble, with property prices soaring because of excessive investments. Thailand kept the baht tied to the US dollar at a fixed rate. This meant the government had to keep enough foreign currency reserves to defend the peg. But the country was importing more than it was exporting, creating a large current account deficit. This meant Thailand was spending more foreign currency than it earned. To finance this gap, Thailand borrowed heavily from foreign investors. As the economy grew, investors felt confident and poured money into Thailand. But by mid-1997, doubts started to grow. Investors worried that Thailand might not be able to keep the baht pegged to the dollar anymore. They began selling off their baht, exchanging it for dollars. This sudden rush to sell drained Thailand's foreign reserves. The Bank of Thailand tried to defend the currency by using about two-thirds of its reserves, but it wasn't enough. On July 2, 1997, the government gave up trying to keep the baht fixed. They let it float freely, and its value dropped sharply, losing nearly half of its value against the dollar in just a few months. This triggered a regional financial crisis called the Asian financial crisis. Countries nearby also faced similar problems. The crisis revealed weaknesses in Thailand's financial system. Banks had poor regulation, and many loans were made based on political influence rather than sound judgment. Companies and banks couldn't pay back their foreign debts, which made the crisis worse. The collapse also showed how risky it is to relying heavily on short-term foreign borrowing and fixed exchange rates. From the trade and capital flow view, the Thai crisis shows what happens when a country cannot pay for its imports because investor confidence disappears. When foreign reserves run out, the country can't maintain its currency's value. The crisis also highlights how, in a connected world, speculative attacks can spread quickly and cause big problems for emerging markets. So, the Thai baht's collapse in 1997 was mainly about economic weaknesses, risky borrowing, and a loss of confidence. It's a clear example of how balance of payments issues and international capital flows can cause a currency crisis.